Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks. This is episode 186, Roth IRAs with Jake Cross. Jake, welcome back to the show.
Yeah, thanks, Jake. Happy to be here again.
You know, the last episode you were on went somewhat viral.
Right. Yeah, I appreciate that. Thanks for everyone listening and tuning into it.
Yes. So that's why you got your welcome back, because of the popularity. So bravo to that. And for today's topic, we wanted to talk about Roth IRAs. And first off, like Jake said, we want to thank all the listeners and viewers out there. The best way to make sure you don't miss another episode of Upticks is to subscribe. So if you're watching this on YouTube, you can simply hit the subscribe button, or on your favorite podcast platform, you can also subscribe there. I also send out a weekly email on Tuesday mornings at 10 o'clock that has all of our content in it, firm updates. There's a lot of info, even though I even slip in a picture of my dog and their Einstein, who reminds you to buy low and sell high. But if you want to subscribe to that, you simply can go to falconwealthadvisors.com, click on over to our content section, and there's a form you can fill in. Just put your name and email, and we can get you subscribed. Perfect. So also, Jake, before we dive in, is anything new going on in your life since we last met?
No, unfortunately, the Chiefs did not win. I know we talked a little bit about it at the end of our last episode we did together. But nothing new, just, loving work, hanging out with friends, doing the usual.
Yeah. And you went skiing in Arizona, right?
I did. Yes. Yep. My girlfriend's family has a cabin up there in northern Arizona. So we were fortunate enough to go up there and get some skiing in.
And are you a skier or a snowboarder?
I do like to snowboard. I know some skiers might not like that, but snowboarding is, a fan favorite of mine.
So do you do both when you go, or just one or the other?
Yeah, good question. I have never skied.
Wow.
Yeah, I might have once tried it out when I was very little, but from what I can remember, it's only been snowboarding.
Good for you. Yeah, believe it or not, I've never done either.
Yeah.
Growing up in Texas, it just wasn't something my family was into. So I had new friends that would go, but I never really got invited.
Right. It's not for everyone. It's not easy, and some people really don't like the cold.
Right.
So that's a big factor, right?
Yeah. Yeah, I'm a golfer. I don't really want to go play in the snow. I want to go outside and play golf.
Right. Right.
All right, good. Well, I'm good. I'm glad you had a good time, and I'm glad you were safe and got home safely, of course, with all that. It's good to get back out there and travel a little bit, I'm sure.
Yeah, it is. Thank you.
Okay, of course. Yeah. So for today's topic, though, we wanted to talk about Roth IRAs. Now, Roth IRAs are somewhat new to the investment landscape. And if you're watching this show, they are actually for young and old people alike, wealthy and not so wealthy people. I mean, there's a lot of different ways you can use a Roth IRA. So Jake and I are going to dive deep today, and we're going to go into it and talk about pros and cons, who should, who shouldn't. Should you do it before retirement, during retirement? I mean, there's all these different avenues. So let's get into it, Jake. So first off, why don't you talk a little bit about when the Roth IRA was first created?
Yeah. So in 1997, there was the Taxpayer Relief Act. And because of that act, the Roth IRA, as we see it today, was created. And it was named after late Senator William Roth, hence his last name. So like you said, it's fairly new. I mean, we have some clients here that, they were retired before it came out.
Good
right?
point.
So it is fairly new.
Right. Yeah. So it is new. So that's why a lot of our clients, we typically work with individuals, in their 50s and older. A lot of them never did a Roth because they were already contributing to a 401k pre-tax, and they kind of just left that go. Now, we're getting more clients in their 30s and 40s as well. And so they are familiar with the Roth. And why don't we talk about some of the rules though, because it's not, so basically it's a type of an account that you can open, but it's not everyone can do it. So that there's a lot of restrictions on who can actually even contribute to a Roth IRA to begin with. And Jake, why don't you go over some of the rules here?
Yeah, so, I absolutely love the Roth IRA, but there are quite a bit of rules. And so it can get quite a bit of confusing. It can get quite confusing, but just a couple rules that we'll go through just right off the bat here. One, you have to have earned income. So if you don't have earned income, right? So it's not income from, capital gains, things like that. It's earned income. So
right, let me talk about that. So not Social Security, not IRA distributions, not dividends. This is typically, you can think of earned income as from active employment, right? Of doing something. But go ahead. Yes, good.
Yep, you're exactly right. And so, let's say, if you only have $6,000 of earned income, you can only contribute 6,000, right? You cannot contribute 7,000. And so, that's a lot of folks, they might want to contribute to a Roth IRA for their kids, which I think is absolutely amazing. But we need to make sure that the kid has earned income, right? Whether it's from a summer job, part-time job, whatever it may be, has to be earned income.
Good.
And, another rule, you can't touch the earnings until age 59 and a half, right? So just similar to a traditional IRA, any earnings you can't pull out. One caveat, though, with a Roth IRA, you can actually pull out your basis whenever.
Yeah, which is interesting. So, and the limits for 2022 are 6,000 actually, right? If you're under 50.
Yep, and then if you're over 50, you get a $1,000 catch-up provision, so you can contribute 7,000.
Right. So if you're 40 years old and you put $6,000 in here, and 6 months later you need your $6,000, you can actually pull that back. But nothing, if you made money, you can't pull any of the earnings. But that's on you though to keep track of, right? Because that's difficult. Because if you think about it, if you put money in a Roth every single year, you're going to want to make sure you're tracking that so that so if you ever do need to get money out of it, you know what your quote unquote basis is, or your baseline contributions.
Right. Yeah, a good way to do it, or just obviously keep track of your tax returns, any statements, make sure that you just know where they are, things like that.
That's good.
And then you should be able to find those answers for you. And, here's the thing. You mentioned not everyone can contribute directly to it. That's exactly right. There's income thresholds, right? And so for 2021, we'll touch on that one just because you can still contribute, right, to a Roth for 2021. But those income limits are based on your AGI, your adjusted gross income. And for a taxpayer that's filing single, that threshold has a phase out period beginning at $125,000 up to $138,500.
They make it so complicated, Jake, right? So what you're getting at is if you're single and you make over 125,000.
Yep.
For a certain range, you may be able to put some money in a Roth, but then ultimately, if you're over that 135-ish number, then you can't. So if you make 200 grand a year and you're single, you can't put money in a Roth IRA.
Correct. Yep. You cannot put it directly in there.
What about married people? What is their threshold?
So for 2021, for a married filing joint, the threshold is 198,000 to 208,000.
Gotcha. Good. So get another phase out range, which makes it nice and complicated. I don't know why they do that.
I don't either. And there's a table for it. And so it's funny, if you make, in 2021, for example, married, if you made 200,000, for example, you could only, and don't quote me on this, but just for an example, you might only be able to contribute, 5,800, right? So it's kind of funny how they do that.
Right. And you did allude to this. So it's not too late for 2021. So you have until tax filing, which typically is April 15th. I think this year it rolls to April 18th, right?
Yep.
So but don't wait. Don't call us on April 18th, please, and say, I want to put money in a Roth IRA, because if you don't have one already open, it's probably not going to happen. So don't wait till the last minute. But if you do have one and you want to put some money in there for 2021 and you're underneath these income thresholds, it's not too late to go ahead and put money in there. And we can talk a little bit why, but is there any other rules that, I know there's probably more rules, Jake, but is there anything else that you wanted to point out, the kind of the paramount ones?
Yeah, so another one is the 5-year rule.
Yeah.
So this is not something that a lot of folks know about, but it could make a huge impact on your financial plan. So you have to wait 5 years from your first contribution, the year of your first contribution, starting in January 1st of that year, before you can withdraw any earnings, right? And if you're over age 59 and a half and you break the 5-year rule, you got to pay taxes. You're not going to pay penalties, right? Because you're over 59 and a half, but you're going to pay taxes on those earnings. You can still withdraw your basis, right? The amount you contributed, tax-free, obviously, but no earnings without any taxes.
And does it only start when you first, like, so what if you put money in every year? Does every dollar after that have to wait 5 years?
No, it's just that first contribution starts that
clock.
Time clock, if you will.
Mm-hmm.
But we'll talk a little bit about this here later in the show. But for Roth conversions, the rules change a little bit. So they like to make it nice and confusing for you. Got
it. Good. So, and maybe we didn't make this obvious, but you know, the whole point, the whole reason you would open a Roth, by the way, is that yes, it was established in '97, and yes, there are all these rules, but the reason you do it is you fund it with after-tax money. But here's the great benefit of a Roth IRA. Your money in the account grows tax-free. So if you put $6,000 and it ends up being $60,000, well, that $54,000 gain that you made over investing it over many years comes out when you do pull it out in retirement is completely tax-free. And it doesn't work that way with 401ks, right? So 401ks, if it's pre-tax in a 401k, you get to deduct the money, so you don't pay taxes on it going in, but all that growth, when you pull it out, is going to be subject to taxes. And so that's why a Roth IRA can be a game changer. So $1 million in a 401k, in a pre-tax 401k or a regular IRA, is not $1 million, because you're going to have to pay taxes on it, right? But $1 million in a Roth IRA is $1 million. So that's why we're talking about them, and that's why they can be huge game changers in a financial plan. Literally, I mean, if you're 35 years old and you're watching this and you just make a little switch and you go from pre-tax to Roth and do that for the next 30 years, I mean, we could be talking about hundreds of thousands of dollars difference, depending on what's going on, depending on your situation.
Yeah, you're exactly right. And another key point about Roth IRAs is, if you have a ton of pre-tax assets, you might be subject to quite a bit of required minimum distributions, right? It's the amount that the government requires you to take out. Even if you don't need it, they require you to take that amount out and pay taxes on it.
Right, when you turn 72, right? So what you're alluding to is when you turn 72 years old, all your money's pre-tax in an IRA, the IRS is going to make you pull money out, which could force you into a much higher tax bracket. Go ahead. I think you were going.
Yep, you're exactly right. And the huge thing with the Roth IRA is that there is no RMDs, because here's the thing: you already pay taxes on those. So, and we'll go into that more in detail, and especially if you guys have any questions, obviously you can feel free to email us or reach out. There's a few other rules, but it has to do with qualifying events, when you withdraw funds, non-qualified distributions, things like that. So if you guys have any questions about those, feel free to reach out about them.
Yeah, thank you, Jake. Yeah, and Jake's email is simply cross@falconwealthadvisors.com, and mine is jake@falconwealthadvisors. Sorry, Jake, I already took your email address.
It's okay.
So let's talk about who should use Roth IRAs and who shouldn't, right? So maybe first off, maybe there's some obvious who shoulds, right? And maybe it has to deal with, maybe talk about your tax bracket now versus your tax bracket later.
Yeah, and so just quick disclosure, I mean, there's so many things that are factors in one's life and financial plan that could drastically change our advice. And so this is not any advice really, but generally speaking, if you're a young individual and you're in a lower income bracket, you should take a look and consider a Roth IRA, because again, those funds are going to grow tax-free pending those other rules that we talked about. And you're not going to have RMDs. You're not going to pay taxes on those dollars in the future when you could potentially be in a much, much higher bracket.
Yeah, good point, Jake. So if you're in your 20s, 30s, 40s even, and your career is still budding, and you're in a relatively lower tax bracket and thinking you're going to make more money and ultimately have more money and spend more money, then but here's the problem with that though, right? Is that you're dealing with Washington and the uncertainty that we don't know what anybody's tax bracket's going to look like in retirement. That's the big problem with this. And unless you're retired today, right? So, but like you said, generally speaking, if you're the younger you are and the lower income you make, typically a Roth IRA makes best sense. But like you said, Jake, some of our clients are making very high income, or they're just under that threshold or whatever. And we will still recommend a Roth for them because maybe they already have a lot in pre-tax. And you mentioned RMDs, which are those required minimum distributions that people have to take at 72 years old. So like you said, it all boils down to your financial plan, but maybe we should talk about, is there anybody that definitely should not do it? Do you have any situation where you would say, yeah, that probably is not going to make sense for that person to do it at all?
Yeah, certainly. I mean, if, for example, if someone's, maybe a little bit older and, they arguably are in their highest earning years, maybe we can take a look at it, but it might not be the best, right? You might need the tax deduction from going pre-tax in a 401k. So maybe Roth doesn't make sense, right? Maybe you don't have a huge RMD issue, so maybe it doesn't make sense, right? And so,
Yeah, good
again,
point.
it really boils down to your financial plan.
Right, good point. So maybe you have all your money already in a trust or brokerage account, and you got a little bit of pre-tax, but maybe then you don't need to do a Roth, right? So again, it all depends on how you have your assets bucketed now. So if you've got a lot in after tax, and maybe you already have a lot in Roth to begin with, so maybe now you actually need to start putting money in pre-tax because you don't have enough there. So you're right. Or maybe you make $500,000, or maybe you make $1 million a year, and you really need that tax deduction regardless of what's going on. Then the Roth might not make sense for you, right? Or you might not even be eligible anyways.
Yep, exactly right. And what's nice about financial planning is it's a process, right? So if, we can touch base on it every year, when we meet and review things. And if there's any changes in your financial plan, we can adjust what you contribute to, right? You're not locked into something.
Yeah, good point. That's a really good point, actually. I read an article about that we can literally, and we do this, we can literally visit it every year. Maybe one year you do the Roth, maybe one year you don't. Right? But it all is based on your tax situation in that given year. And then we can juggle it, really. That's really, to us, that's really a big value add in financial planning. And we alluded to this too, that actually some 401ks offer a Roth feature. And Jake, maybe you should go over that a little bit as well, because I know the limitations aren't as strict with a 401k and a Roth, right?
Yep, you got it. So Roth 401ks are, could be better than a Roth IRA, right? So there's a couple of disadvantages, right? But there's no income limits for Roth 401ks. So you could make 500K, and if you expect to make, $1 million in the future, then you should look at a Roth 401k, right? You don't get that tax deduction, but you can still contribute. And for 2022, I believe it's $20,500 into your Roth 401k. Right. So you don't have to worry about that phase out threshold.
Right. Not only do you not have to worry about the phase out, but you can put more than that 6,000 or 7,000 in the Roth 401k. So you actually can put more Roth dollars away by using that. So Roth 401ks are a really, really good opportunity for people. But again, it's not a no-brainer. Like you said, I don't think everyone should do it. And typically, company matching does not go in the Roth. It'll go pre-tax still. So your money can go in Roth, but the match, if you get a match, might come in pre-tax. So it's definitely something to look at though. But we are huge fans of Roth 401ks. But again, it's case by case. It's not a no-brainer. Not every client should do a Roth 401k. But if you have one, we definitely should talk about it. Yeah, good. So let's talk about real quick. There's a controversy right now happening, right, in Washington that they are trying to eliminate a strategy called a backdoor Roth IRA. So to make it even more confusing, Jake, why don't you explain to our audience what a backdoor Roth IRA is?
Yep. So it's in a way a slight loophole where you can make a non-deductible IRA contribution to your traditional IRA and then convert those funds over to a Roth IRA. Now, Washington has proposed to go away with the backdoor Roth. Is it going to go away for sure? We don't know. Obviously, we're just gonna, take those punches as we get them. But, this way you can, if you're over those income thresholds, you can still, in a roundabout way, get funds into a Roth IRA. And so this has been a strategy that I know quite a bit of our clients have implemented and has added tremendous value to their financial plan.
Right. You have to be careful though, because if you already have an IRA, a pre-tax IRA, and you try to do this backdoor Roth, it gets complicated. So because you have to convert the money proportionately. So you might not be able to do it. So my point is, if you already have an IRA, this backdoor Roth might not make sense for you, especially if you have a large IRA. If you have a small IRA, it might. But if you have no IRA, then I really love it, right? So if you don't have any money in IRA assets, maybe all of your money's in a 401k, but you make $300,000 a year, or you and your spouse make $300,000 a year, then that is what Jake is talking about. That can be a powerful vehicle to get money into a Roth every year. And so, but they might do away with it. So it's more of the reason, in my opinion, to look at it now, before the rules change. Now, theoretically, they could backdate it. And that's what our spirited debate internally is that the IRS could change the rules mid-year and say, well, if you did this as of January 1 of 2022, you got to go fix it. But that's fine. We'll just fix it, right? But yeah, the backdoor Roth can be something pretty powerful, especially for those high earners, to get some money in a Roth IRA. But you have to be careful. Again, if you have an IRA, don't go try to do this on your own. And again, we take all this in conjunction working with your CPA. You want to make sure that your tax accountant is on board, your tax advisor, which we aren't tax advisors. We do tax planning, which is different. But we got to make sure that your accountant is on board so that he or she knows how to file this correctly, frankly, because I don't want them filing it wrong or causing you unnecessary tax burden, right? So that's good. That's a lot, right? And then the last topic, and then we can kind of go, if we want to go into any more detail, Jake, is Roth conversions. And this would be for our typically clients that are retired, or maybe not even retired, but why don't you explain what a Roth conversion is?
Yeah, so it's, in simple terms, it's taking your pre-tax assets, right? So like a traditional IRA, and converting it into a Roth IRA. So there's no income limits for a conversion, nothing like that. You can do as many conversions as you want in a year, and you can theoretically convert as much funds from pre-tax to Roth as you want. Now, take note, it is a taxable event, right? So the amount that you convert is going to be taxable income. But, the huge thing is, for example, if you're, the year that you retire, you might drop into a lower income bracket and have a lower effective tax rate. And, it might make a lot of sense to convert some of those funds from pre-tax to Roth, right? Because you're going to be in a lower income tax bracket. It's going to lower your potential future RMDs. Those funds are going to be tax-free eventually.
And your kids, right, or whoever you want to ultimately give the money to will inherit that money tax-free, is what that's why some people do it, right?
Yeah, I think estate planning, it's an amazing estate planning tool. There's always two parts to doing Roth conversions. One is going to be more of the living benefit, if you will. Is it going to add value to your assets that you're pulling income from during your lifetime? And then the second part is going to be, in terms of estate planning, right? Do you want to pay those taxes for your heirs to inherit those funds, right? And so, it might not make sense for during your lifetime, but it might make a ton of sense for inheriting it, right? So it's going to be weighing those two factors there, but it could be a super advantageous tool.
Right, exactly. And so that's kind of our point of today's conversation. And before we do the Roth conversion, what our team does, which is a lot different than a lot of other financial advisors, in my opinion, is we actually will take your tax return, right? We'll take your most recent tax return that you filed. We purchase basically some tax planning software that will scan it into, give us a lot more details and data about your current tax situation. And then we will give you guidance on if you should even look at this Roth conversion. And if you should, we can give you guidance on exactly to the dollar how much you should consider. Again, running that by your CPA, of course, as well, right? So we've taken this Roth conversion and tax planning to another level. We're very serious about it. And because of that, we've invested into software that has all the algorithms, the tax laws, the state laws, all that junk, all built in, so that we're not just eyeballing it, right? So we're actually getting the hard data from you, marrying that with the laws and the rules, and then giving you some tax planning guidance or observations on that. But that's the point of today's, podcast, is that Roth IRAs, I don't think are as simple as people think they are. I think they're more powerful than a lot of people think they are. And they're not just for the young people. Like, we have clients in their 60s, right, that are either converting money or looking at contributing or doing, so I think it could apply to literally anybody at any phase of their life. It really just boils down to, what are you looking to accomplish? What is your current financial plan? And how can we improve on it?
Yeah, but I 100% agree. And, I hate saying this, but you're exactly right. It just
You hate saying I'm right?
It just depends, right? Not everyone should do it. It is an amazing tool, an amazing vehicle, but it's just not for everyone.
Right.
There's pros to pre-tax, right? There's pros to a traditional IRA. I think a lot of people, there's a lot of hype, if I may say, that going around with Roth IRAs, and, yes, they're amazing, but they're really not for everyone. So it really just depends on your financial plan and really what your goals are, right? Because for example, the estate planning piece, if you really want to provide a great legacy to your heirs and you're fine with paying the taxes for them, it could make a lot of sense regardless. So it just depends.
Yeah, really good point, Jake. And, frankly, if you're a business owner and you're watching or listening to this, I'm a fan of just investing in a brokerage for a business owner even more than a Roth, because it depends on what type of business you have, right? But a lot of business owners have volatile income, right? There's more risk. They might need their money. And like you mentioned, you can't pull earnings from a Roth IRA until you're 59 and a half. So if you invest all this money and then you have a volatile job or career and you need access to your capital or need to borrow, you can't borrow from a Roth IRA either. There's some benefits to not doing a Roth and just putting money in a brokerage account. So like you said, it's not for everyone. And frankly, I like a lot of clients just in general. I mean, if you're worried that your career might be volatile, right? If your company's getting bought and you're worried about your job, like, building up money in just a brokerage account is not a bad idea. So again, like you said, it's not for everybody. There's a lot of hype, but we love Roth IRAs for the right people. I think it makes sense in a well thought out financial plan for certain people. But like you said, this isn't advice. Today's show is just, we wanted to roll out all the things a Roth can look like and be and do. And the most important thing is that we just have a conversation about it. I mean, that's as simple as it gets for us. So every time we check in or meet with our clients, we're taking a look at that. Does a Roth conversion make sense at this point? Should they start contributing to a Roth? That's just kind of in our little checklist of like, hey, what's their tax situation look like? How can we improve it?
Yep, you're exactly right. And you mentioned before, for any existing clients or really anyone, if you want to take a look at some of these scenarios, send us, your tax return for 2021. We'll take a look at it, and we can run through some scenarios and see if, a Roth IRA or Roth conversion would make sense.
Yeah, that's good. That's good. Is there anything else that we left off about Roths that you wanted to talk about, Jake?
There's a few little smaller rules, but again, if anyone has any questions on it, feel free to reach out to us. It gets pretty nitty gritty, so I don't want anything to get lost in translation through, the show. So if you have any questions, feel free to reach out about it.
Yeah, good. Yeah, and a good summary on this one. So again, there's income limitations, there's contribution limits, there's a time frame when you can contribute. So again, you want to be careful. I would encourage people not to go at this alone. You want to hire a wealth advisor to guide you through it, or work with your CPA on it. That way, just to make sure that you're doing it right, because there can be some harsh penalties, or you might have to pull money out, and you don't want to mess with all of that. You want to make sure if you are able to contribute, that you're doing it the right way, and that everything is compliant. That way you can get the most benefit and most use out of it. Very good. Well, Jake, I know we got to wrap up. We're recording this on a Friday. I'm sure we got a busy morning ahead of us, but do you have any plans for the weekend? Anything fun going on? Spring is finally in the air, kind of.
Yeah, just really enjoying the weather. I know we had a pickleball event not too long ago, and ever since then, honestly, I've gotten quite into pickleball. And so
Nice.
Hopefully tomorrow morning I might get together with some friends and play some pickleball. But other than that, just, recharging and, just chilling out.
Now, I thought that was a retiree sport. I didn't realize that younger people. So where do you go play?
So there's some couple courts, locally in Prairie Village and then Lenexa that are open to the public. And so we'll just go there. There's quite a bit of people that go there. So we'll just take turns with the different groups there, and we'll play with my friends. It's, it's not a retiree sport. A lot of people might think that, but I would encourage people to go try it. I never played tennis or anything like that when I was younger, but it's a good change. I like it. So
Now, do you have your own racket?
I don't. That's the next step.
Got it. So you just borrow one of your buddies and.
Yep.
Got it. So you're gonna you got to get into it. You got to get your own pickleball racket.
Yeah, I know. That's the next thing I need to get. So we'll see here in the future if I get one.
And we'll get you a Falcon sticker to put on there.
I like it. That's some advertising.
Good. Well, good. Well, I hope you do get out there to get some exercise and play some pickleball. And we hope all of you out there are staying safe and healthy. Thank you, Jake, for joining me on the show.
Thank you.
And thank you all for tuning in. And we hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.